Howdy, Team 42. It's your skipper here, Darius Dell, to present another episode of our Pro to Pro Live. I'm joined by our friend Kris Naidu, founder and CEO of Zeacon and a private investor extraordinaire. How you doing today, Kris?
Doing good. How it's up, Derek?
It's a real pleasure, man. You and I were connecting. So, full disclosure, I'm a private investor in Kris's company, who himself is a sort of well-renowned, well-respected private investor on the West Coast. I'll let Kris embellish his own background, but full disclosure, I am invested in this company, so I just want to make sure everyone's aware of that before we hop into this discussion. That's how Kris and I know each other. So, Kris, tell the audience a little bit about yourself and why they should take some time out of their busy day to listen to a grizzly veteran with the hat on and the Range Rover.
Yeah, I think first off, it's like thank you very much for having us or having me on your show. But first off, like I think a good reason to listen to me is I've done this quite a few times, and then I've done it from two aspects. One from I invest in things I know, and I've been in tech for 20 years. And another thing is like my success rate's been pretty high, and it really comes down to really knowing what you're investing in and kind of how the framework works, and really paying attention to things that are in the private sector. When you're investing in a private, it's not there's not as much information that you have at the public sector. They're not as well renowned. They don't have the product's not as defined. It's really about being able to tell where something's going, so then and then being able to understand if the people you're investing in are the team that's going to be able to take the product or the service to that place where you think everybody's going.
Yeah, I love that.
And
I
then,
was going to say, tell us a little bit about your. So that's a lot. You just shared a lot of insights already. So that's tell the audience a little bit about how you may have come to acquire some of this experience in terms of knowing where the puck is headed, essentially.
yeah, I mean, I think what's really important to do in terms of investing and understanding where the puck is heading is seeing trends, right? Like, I think everybody that's been watching your series or has read up on your stuff, it's a lot about what's trending and what things are happening. It's about looking at real world events, like as we see today, AI is really taking shape. And then looking at use cases and when I say use cases, how people are going to use the technology to solve their problem, and seeing where everybody's going. Like if you see things that are archaic, for instance, I see like the medical industry is very archaic, and AI is really going to be able to help it. Financial industry is another one where it's going to be able to compute a lot better than what's out there totally right now, and be able to do um, be able to solve those problems a lot quicker than people can. So I think it's just understanding, first of all, what the technology does, who's utilizing it, and what industries it'll best be utilized in and solve the biggest problems. And if you can get in and understand, okay, where people are going right now with that technology, and then where their best use cases are, you can invest in companies where you think the team might be able to take it very quickly.
Yeah, I respect that. So let's go down to let's start with a 30,000 foot view on sort of where things are. Sort of what are you working on currently? What's kind of top of the mind when you think about your portfolio of private investing, and I'd love to hear some insights there.
Yeah, so predominantly a lot of the stuff that I was investing in was a lot of AI and a lot of uh, problem solving for consumers. So I invested in a company that does like it's basically like uh it's Uber for handyman, for a lot of people that are, their businesses or companies that don't have a somebody on staff that can do that, and they need people that are certified to solve these problems. And um I invested in them. I invested also in an AI company that was a chatbot company. Uh, and I've invested in probably about, I would say about 10 startups over the last 2 years. And all of them have two themes. One, they solve a problem, have a good team, and then also have significant capital from like good investors that have already invested in, that did due diligence. So, the most array of everything that I'm investing is from real estate, and then AI, which I think are the two things that are going to be uh, the the greatest upside in the next couple of years.
Gotcha. So how does one get involved in 10 deals over the past couple of years? Obviously, it's not like you can just call go pull up a Bloomberg and say I want to be part of this deal. Walk us through sort of how, this sort of ecosystem, if you will, this private investing ecosystem. How did you become a part of it? What's your background? How did you get a ticket into this industry?
Yeah, so I've been in startups, I've been CEO for a couple of, 6 or 7 years. And I started investing really about getting in the ecosystem is I went to like an angel investment, um, like a kind of thing that they have in Seattle. And there was a bunch of companies that come pitch there and you're able to make a private investment. It was kind of my first foray about 10 years ago into it. And it taught me a lot. Like the first time I really went in with what my baseline understanding was, but going into a group of people that have experience where they've been doing it for 20 years, and then people just started doing investment, it gave you kind of like a good catalyst of understanding what to do, what not to do, and also what more advanced investors are doing. And it really helped me kind of understand the ecosystem because I wasn't by myself. I was with a bunch of people that knew what they were doing. And it helped me kind of just get my feet wet and truly start understanding.
Let's talk about your biggest win. What did you learn from that? Tell us about it.
My biggest win was, it was a large, it was into a large search engine. And it was luck. I mean, let me be
Do we know
completely
who the
honest.
search engine is?
Yeah, it kind of, yeah, kind of. But it's like it was really literally luck. It was just being at the right place, the right time, also having an experience of working in that kind of environment, and then being able to invest into it. So um, it was my first foray into kind of learning everything. Was that once you get into something like this, is you understand kind of the multiples, right? Like you can invest in the S&P 500 and you might have a chance of making 100 200% return, or Nvidia where you can make it tremendous in a short amount of time. But those are the rare kind of feats that you ever see with that kind of return. In the startup world, I mean, there's people that invested in Bezos and all these companies, Starbucks, very early on, and their returns were thousand multiples. And of course, the risk is the reward, right? Like you're gonna have to go to a lot of companies, really understand your stuff to hit these companies. But if you get into these kind of ecosystems, you get in early, you understand the business. They literally can be, these huge returns, and in a 5 to 7 year time frame.
Yeah, I gotcha. So tell me about your worst investment. What did you learn from that?
My worst investment was probably something I did not too recently, but where I'm dealing with recently is I didn't pay attention. I just I invested because the product was great. I did all the research on the product, understood where it was going, but then I didn't really pay attention to my paperwork. And that's one thing as an investor you have to really pay attention to is, what am I signing up to? What is my equity stake? Where am I getting my information? So once I signed up to it, knowing full well the company, the product is good, but my paperwork wasn't good. And it took me, it's still something I'm dealing with today, trying to get everything figured out in terms of my equity stake and everything. And I put in a large sum of money. You never want to do all that at the back end. You want to make sure you establish all that in the front end. And it came down to not taking the time to really be aware and really rushing through the process.
Gotcha. Gotcha. So it seems like, I would imagine someone, of your caliber in terms of your history in private investing, you're probably getting shown deals on a regular basis, I would imagine at this point.
Yeah, you are. I mean, I think once you start investing and they see your name on a couple of cap tables, then more people are likely to reach out to you. And especially as if you're a founder, if you're in the ecosystem, you're always running to people that need advice, and then, hey, are you willing to invest? So I think it's really making sure that you do all your, you don't just research the company, but really everything that you can, and understand the paperwork and read through everything before you sign. I think that's one of the biggest things that we could do as people investing in the private sector.
What are the types of I don't know, pitfalls, if you will? Because this is, I think this is a fascinating conversation because most of our clients and most investors in the world are generally, when they think about investing, they're thinking about public markets, liquid asset classes. There's a select few investors in the world that have the privilege of thinking about investing from the lens of the private asset classes. those are usually the people with the most money and the most connections. And so, when you think about, sort of how to, having to go through this process on your own and get to where you are now, you've obviously accumulated a lot of, battle scars and whatnot, not only just victories, but also battle scars. What are the types of things in those documents that investors should be looking out if you're, let's say, early in your career as a private investor?
Liquidation preferences, if your stock is preferred or common, um, about dilution clauses, about what information that you're privileged to, requesting information, what you should be able to get, um, exactly who your point of contacts are within the company. And then understanding too is like, okay, what time of your exit, right? Like when you go into investing into something, well, it's not a charity. Usually when you're investing in a startup, it's about, okay, I'm going to put this in. What is the timeline do you think that you're going to be able to get your return on, and making sure that you pay attention to all that stuff? Because there's all kinds of checklists that you can get. I think there's a lot of companies that do a good job of like, hey, these are the things you should ask, but until you go through the process, you're really not going to know.
Yeah, that's true. And so when let's take a step forward and sort of focus on the actual investments, the companies. What makes it a great startup? What makes it a successful startup?
you know I've been asked that question a lot, and I think it comes down to team. The first, the product, I think I've heard this before. It's like people, product, and process. It comes down to those three, right? Like you need to make sure that the people that are there can actually have experience or can do the job, and make sure that they can accomplish what they're going for. And your product, the product that they're developing, is it possible to do this in a desired time frame, and is it going to be good enough so that the users or the customers utilize it and pay for it? And then the process is, okay, when you figure out the people and the product, what process are you going to put in to make sure that it goes to market correctly and it gets a return, right? Like if a company's not making money, then there's not going to be anything in return for the investors. So what is the process to get it to the market, and then also to get start getting profitability within the company? Those are all things to make sure that everybody is paying attention to very closely.
Yeah, totally. I mean, I think I've heard this several times, when I listen to, podcasts or other investors talk about private investing, and this whole concept of team, always comes up, make sure you got the right founders, the right, team in place. Doesn't every startup have a bunch of smart people, with, their fancy degrees and their, fancy experience?
Yeah,
How do you determine one startup from having a quote unquote good team from another? What are the types of things are you looking for?
um, I don't really equate it to like education. I equate it to experience, like battle scars. Um, the reason being is like education, I think, is like, I mean, it's a phenomenal thing. I think everybody goes to different schools, but the real thing that you're looking for is the ability to problem solve, right? Like people have to have the cognitive ability to be a leader, and then to problem solve very quickly in a startup, because you're experiencing problems that you're just experiencing. It's not everybody else, because you're in a startup. You might have some people that have experienced something similar, but if you're developing a new product and service, it's not going to be exact. So you have to really make sure that the people are able to quickly analyze these things and make adjustments, and have a network of people that they can learn from. So if they're not able to learn, they could be the greatest leader, but if they can't learn very quickly and then lead their team to make sure that they find the answer, then they're going to die in a startup.
Gotcha. Yeah, that seems like a hard thing to ascertain, and that requires a tremendous amount of due diligence when you're on your way in as a private investor, to understand if the leaders, the founders of the company, the guys in charge, guys and gals in charge, are really can actually do what you just said. Because that to me is probably really that's a really hard thing to determine if someone's good at it or not. Is leadership.
Yeah, it's a really hard thing. I mean, investing in general is hard, but in startup investing is it's like anybody that has amount of money they worked extremely hard for, and then you're investing into something brand new. It takes a lot of due diligence. Like I wouldn't recommend somebody in investing in startups that didn't have experience, that's just going on a whim. I think they really need to do their due diligence and understand what they're investing in. The people, like taking these steps are so important, because before you even start, you need to do these things because you're gonna waste your money if you don't.
Yeah, makes sense. Yeah, I mean, I don't know. You've kind of gone through this. You've got your own in terms of your career, guy, in terms of your
Yeah,
career in investing. What sort of? I mean, obviously, you can't give blanket, financial advice, and this is not blanket financial
yeah,
advice. Generally speaking, as an investor, what percentage of your portfolio is sort of, private? If you let's say you were accomplished and you've done well, you got decent money in
yeah.
the what percentage of your portfolio is private versus public?
I'd say it's kind of interesting because majority of mine, I would say 50% is private, and then 50% is public. I would definitely not suggest that. I would think like it should be more about 10%, I think private, and then 90% more public. The reason being is, you know, I, I don't want to ever tell anybody like, hey, startup investing is not risky. It's extremely risky. That's why I'm coming on here to be telling people to make sure that they pay attention. But I've I've done it so much in my career, and that's what I know, through experience. That's why I've done it. And I've had great outcomes. Now, it's important to note that, 1 in 10 of them will fail. And in order to find that one, it's very difficult because a lot of the times is, when they're in seed stage companies, there's nothing, right? There's a plan, there's a sort of a plan, there's a deck, and there's somebody expressing their desire to solve a problem. And then you got Series A, Series B, they start showing traction, Series C. So I've been a seed investor. So just think about that. I have people coming to me all the time, with an idea, a concept, and a team, but there's no product or service, and they're asking for money. So it took me quite a while to get experienced on that in order to be a good investor at that. And I've had a lot of losses in the beginning, but as you get better and better at this, you could spot kind of the success stories. And it's kind of like, I think the best way to look at it is during a downturn, something like this, I would say we're kind of in a financial kind of a different time period than we were maybe 2 years ago. This is where you kind of find the best startups, right? A lot of people got laid off. um, they're trying for something. They were in industry, they saw things they didn't like. Now they are looking for a new option and want to work for themselves. So this is the time you're going to see a lot of startups that are great come out of here, like we did in 2008. You saw, look at all the companies that came out of 2008 when we had the crash.
Totally. Creative destruction, man. It's one of the most important things in a capitalist society. I would argue we haven't had enough creative destruction in the last, 15, 20 years, really since the post GFC era. And a lot of financial repression, a lot of currency debasement, a lot of keeping the existing players, at the top of the existing industries.
Yeah, it's been, from the investment side too, is like, when everybody is making money, then that grit goes away, right? Like,
Yeah,
what's the ethos of somebody to really push out and go start something new if they're getting paid $500,000 as a programmer, and they're really happy at what they're doing and it's very easy. Now you come into what we're coming into today is where things are changing with AI taking over a lot of jobs. People are now being like, hey, I need to start a new career, and that gives them that grit to go and start something. And that's when you see a lot of problems solved that we see currently.
yeah, agreed. And I'm glad you brought up AI because we got NVIDIA earnings this week. Obviously, it's a huge catalyst for broader asset markets. You've had boots on the ground in tech and in AI specifically for many, many years. Way before we knew what AI was as a buzzword in public markets. What are your thoughts about where we are in that development curve? Are we going to start to see more exciting products and developments, or are we still a little bit too early in that cycle with a lot more kind of near term market risk associated with these valuations?
You know, AI is interesting. I mean, I think the concept is really cool. I think there still has to be a lot of vetting done, and then actual use cases where you're seeing, it making money for people depending on its price, right? Like if you think about it, anytime you have some tech like that's requesting data back, it requires huge server burn, which is a cost. So you have to get a utilization case, which means like, a use cases that don't that are very simple, that it starts having a streamlined idea on how to solve and make it very specific. Because I think like when we say AI, it's such a broad thing AI has been around since like World War One, or actually World War Two. It's been around for a long time now. It didn't have the computing power that it does today, but it's been around for a long time. We're just starting to utilize it, more sort commercial use. And on the commercial use side, it takes a little bit of time. I think, it's has great use cases, but there still need to be vetting about how to utilize it more effectively and how to get it out there. I mean, I think in the next year or two, you'll start seeing it start to optimize. Like the best thing is mass production, right? You get a ton of it out there, and then you start having the actual. It starts narrowing down to the actual players, and I think it's getting a lot out there right now, and you're not going to see it get down to the actual players probably for the next couple of years.
Wow, that's a relative to what I thought I knew about AI, that's somewhat of a bearish timeline, to be honest with you. You know, there's a lot of, I would say, angst is probably too strong of a word, but whatever word is like right below angst and on the ladder of how people feel, I think there's a lot of angst associated with, okay, we want to start to see some things now because, as you know, public markets are egregiously valued, relative to, relative
Yeah.
to the prior tech bubble. And so a lot of investors are saying this thing has to be better and bigger than the internet, and it has to be better and bigger than the internet pretty soon. Otherwise, we're going to have start to see some volatility in markets associated with these lofty valuations. And 1 to 2 years from now, it's not, I don't think, on anybody's bingo card. I'm thinking they're thinking like
You
three
know,
to 6 months from
that's the problem, I think. I think when you try to rush something like this, right? Like you got regulatory concerns, right? On how to utilize this stuff and keep it from going outside of it. You got brand new technology. When you have brand new technology, and first of all, it's autonomous, right? Like it's like not telling it what to do and it does it by itself. It's giving it direction on what you want it to do, and then it does it. So, it's learning and it's getting better. I think with all those concepts, and it's advanced, right? Like as easy as we might make AI to sound, it's not that easy because to get it to do exactly what you want takes it a little bit of work, and you have to understand how to write to it to do what it does in the tone or the present or the structure that you want it. So I think there still has to be timing to do that. I think thinking it's going to be done in 3 to 6 months. I mean, there's some use cases like that are people that are using, AI for a while. Like we've been using AI for a while on what we built, but it's us knowing the ins and outs of it, and it's been doing it for a couple years. To get that um from a new product or service, I mean, there's too many unknowns, I think it's when we're rushing into getting it to commercialize in the capital markets. I don't necessarily think what they think is realistic to people that are actually utilizing it.
It's a hot take, my friend. I like it. That's spicy. I appreciate you sharing that, man.
Yeah,
That's
it's
great.
just me personally. I mean, I've just seen people say AI for the last couple of years, and I'm like, okay, I mean, it's been around for a long time. How are you utilizing it? Like, well, how does it make you money? How does it advance your business? I mean, those cases it does, but it's still being figured out.
100%. I would say you are very much relative to my own limited knowledge, admittedly limited knowledge of technology. I would hear you talking about AI before we heard about, what's it? I'm blanking on the name.
Open AI.
AI, yeah. You were talking about AI back in 2020, 2021. And then, I didn't really know what it meant. I think I still kind of don't know what it means, but I think I know what it means a little bit more than the average, kind of investor out there. And at the end of the day,
Yeah.
telling me that there's a mismatch between what can be developed and how long it takes to develop in terms of use cases and good product versus what I think in the market is that this stuff's, fairly imminent. That could cause some problems in asset markets in the next, 6 to 12 months, in my opinion.
Yeah, it's like one of those things, right? Like people don't understand this, but it's like a brain. So think about an early development child brain.
You got one of
So
those?
you're feeding it data into this small child brain that needs to grow and understand what it's seeing, right? The information is well relevant and but it's a child. It can't really apply it yet. So as the child develops into adolescence and adulthood, it's going to be able to apply it. So that's the best way to look at it is it's like a child brain needs time to develop. And then yeah, it's getting all this information. That's great. But if we know about children and adolescents and how young they are, just because you give them information doesn't mean they're able to apply it because they're not ready for it. So that's my thing about AI is it needs time to develop and understand how to utilize it because it's like a development of a brain.
Yeah, that's very helpful. That's I if people learn nothing from listening to this video, then I think that's one of the more important takeaways is that this is a process that by definition it has to take time in order to fully develop and develop these products. And eventually we will get all the products. It's just that the timing mismatch associated with what is maybe priced into public equity markets now relative to what needs to happen in the next, let's call it 6 to 12 months to satisfy sales and earnings growth estimates. That, in my opinion, is where you could have some disconnect. Doesn't mean AI isn't going to be amazing and it's going to solve a lot of problems. It just might not be amazing and solve problems on the time horizon that investors are currently assigning those valuations to. And that is the issue, right? That is how you get to a bear market.
Yeah, no, definitely. I mean, it's when you're continually investing in something that they don't quite know about, like that's what causes like, if we look at the dot-com boom and the bust, right? There was legitimate companies out there, but then there was a lot of fakes, right? Like people, I think what you have to look at in the AI markets about the fakes are like people wrapping, like there's a chat GPT, they have their own open source, which is like an API. They take the API, they wrap around a capability around it, but it's not native, meaning they didn't build the AI, but that they raise 100,000 or a couple $1 million based on this wrapped AI. It's not even theirs. It's not native to them. They never built it. They just can do a task and solve a problem using something else. So truly they have no IP. So I think like, just like the complexity of that thing, what I'm talking about is advanced enough, right? But it's essentially it's people are using other people's AI and saying it's theirs because they add one thing to it. And that's the big difference here is like when we're looking as investors, really understanding, hey, what AI is, what problems it solved, how long is it going to take to solve this problem? And then what's the value of the problem it's solving? Like how much money is it? Is $50 enough for the customer to pay for to solve that problem? Or how much are they willing to pay for that problem? And all those things have still not been determined yet. So how the fact that we're trying to think about it in commercialization piece that quickly, it's hard. It's doable, but I don't think it's feasible at this point in the next 3 to 6 to 9 months. I think we're a year or two out.
Gotcha. No, that's really helpful, man. Well, you've been super generous of your time. I want to shift gears a little bit to kind of a game we can play towards the end because one of the reasons you and I are having this conversation on our platform is because we want to make sure that we're democratizing the kinds of conversations that are happening behind closed doors for folks like us who maybe didn't grow up with all the great benefits of starting and starting on third base for lack of a better word. So I'm going to
Yeah.
show 3 charts over the next 3 screens. Each one contains an important rule of investing, not just how to invest specifically, but just broadly speaking, how to approach investing as either a professional investor or as a retail investor. And I want you to think of an investment that comes to mind for you specifically. So, Colin, if you throw this first slide on the screen where we show the 3 most important concepts of investing. Rule number 1: don't lose money. We learned that from our friend Uncle Warren Buffett. And the reason we say that this is rule number 1 is because when the percentage recovery required to break even after you've lost money grows at an exponential rate. So, for example, if you're down 25% in a position or a security, you have to go up. The thing has to rise 33% from there to get back to break even. If you're down 50%, to double. If you're down 75%, it has to quadruple. And so investors need to be aware that the recovery it grows exponentially, and so losing money is a significant detriment to the overall long-term investment performance that you're going to have in your portfolio.
Like when I look at this chart, if I was to compare something, this would be, in terms of losing and recovery and seeing it be like Bitcoin.
Yeah.
This would be a good chart to kind of like, I would apply that same method or what you're talking about on Bitcoin over here, where you see it, where it has, steady growth and then it has large losses and then it does like a retrace and then it goes back up. I think this is it right here
Sounds good. I
in
like it.
comparison.
100%. Yeah, this is I would argue that our friends in the crypto community, we have a lot of clients who, our clients, we're very blessed to have the very, sort of wide distribution of clients. On the high end, we have, institutional CIOs, PMs,
Yeah.
everyone knows, across the global buy side. And then on the, sort of less sophisticated end, and don't mean that pejoratively, obviously, we have folks who, pretty much only trading Bitcoin or only trading Solana, or, so we try to create products and solutions that, can speak to all those different investors. But I think
Yeah.
this chart here is really important to understand that, if you're going to be an investor in the crypto market, you need to understand that it has significantly outsized negative returns, and they happen relatively frequently. And so, it's your goal, if you want to compound returns, to make sure that you're not participating in those significant drawdowns.
No, that's perfect. I mean, that's the same thing I looked at it on this was for crypto when I first saw it.
All right, cool. So rule number two, don't invest money that you cannot afford to lose. So this chart shows the percentage of time for these three asset classes where they're down 20% or more from their highs. And so 37% of the time of the S&P 500 since 1928, the stock market has been below 20% or more below its previous high watermark. That's 26% for U.S. Treasury long bond futures with data since 1977. And then 79% of the time, Bitcoin has been more than 20% off of its highs since the inception of that asset class, 15 or so years ago. And so the key takeaway here is obviously, if you need the money, you probably should invest it, because there's a reasonably high percentage amount of time where you're going to be underwater as an investor in those asset classes. Again, 37% for the stock market, 26% for the bond market, and 79% for the crypto asset class. Anything comes to mind when you see this?
Yeah, yeah. If when I look at this is like startups.
Mm.
The reason being is like, um, you know, you have like the stability of, like blue chip startups that are always going to be going up or doing good news. Then the treasury bond is like the stable, like I would see like they've already got to series like D or E. You're going to make your money. It's just not going to be that much at that point if you invest in. And then you have like seed, right? So that's right there on the right, which
Yeah,
is like it's always down or up. You just don't know. But I'd say that this would be a good way to be like a progression from a startup to investing into like more stable assets. So startups would be in the right. The middle would be like mid capital companies, and then the other would be like looking into more safer assets that are all. But that I would look at it the same way.
100%. Yeah, and I think, one of the more important takeaways is that, if you need the money, there's a reasonable chance you're not going to be able to get the money for a while.
Yep.
And so that's,
Yeah. Or you're going to sell at a loss, no matter
or you're
what.
going to sell at a loss, and that's the problem.
Yeah.
Exactly. Bingo. Absolutely. So that's rule number two. Don't invest money that you cannot afford to lose. And then finally, rule number three, your average return is not equal to the amount of money that you make. This is one of my favorite charts. It probably takes a second to explain, but I think it's really important that I explain this. And if you have not heard of the concept of volatility drag, definitely stick around to watch this, because it's arguably the most important concept in investing that nobody ever talks about, in my opinion. So in this chart, we show investment strategy A and investment strategy B, the blue and the red columns respectively, what the actual, how the position grows in nominal terms, those are the columns, how the position grows in percentage terms, those are the dotted line returns. And as you can see, both investment strategies, investment strategy A, the blue one, and investment strategy B, the red one, have identical 50% average annual returns. They have 50% average annual returns. The investment startup, or sorry, the investment strategy A, plus 50, plus 50, plus 50, average annual return. Investment strategy B, minus 50, plus 100, plus 100. So they wind up in the same place in terms of the average annual return, but they do not wind up in the same place in terms of the size of the position and how it grew over the course of the investment horizon. So if you are in investment strategy A with the 50% average annual return in investment strategy A grows from $100 initially to $338 after year three. The $100 in investment strategy B with the same average annual return only grows to $200 after year three. And the reason for that is volatility drag. If you have a significant outsized loss in an investment early on in the investment, you now then are compounding returns from a smaller amount of money. And compounding
Okay.
returns from a smaller amount of money takes you to a lower ending point when you're talking about, making the final sale and booking whatever gain that you have in investing. And so this is what I talk about with crypto. Yeah, obviously, if you're going to be, super long crypto assets, if you're a young person who can afford to have those types of investments, or if you're, done really well in life, you can afford to have a lot of startup investments in your portfolio as you do now, Kris. The reality is, if you lose money early in those investments, you wind up with less money over time, even though you might experience the same outsized positive returns that everyone else is experiencing. But just because you started, it had such a poor start in terms of compounding, you wind up with a much lower level of money. And so to me, this is probably what I think of when I think of this chart. I think of crypto. It's the number one thing, because most folks say just be max long hodling crypto, but you can be max long hodling crypto and wind up with $338 in investment strategy A that obviously thinks about drawdown risk, and or you can wind up with $200. And obviously we know which one is more than the other. So anything that comes to mind when you see this?
Yeah, first of all, it's very advanced, but it's this would be like gambling. Yeah.
Have a
Yeah,
coach there as well. Oh man, yeah. No, this is it. I like you're one of the people I have a lot of the utmost respect for, man. You've done a lot for our community, in terms of opening doors with folks like myself, in terms of getting into private investing. So I just want to say thank you for that, and thank you for your time in terms of trying to give some game out, because at the end of the day, we don't get to where we would like us to be unless we folks like us are making it, sharing the insights and knowledge and opening the doors for us. And so I'm grateful to have you on the program, and we'll definitely have you back, man.
yeah, absolutely. And two is like read up on this stuff, right? Like a lot of this stuff is like very advanced concepts. I think it takes like more knowledge than just listen to a podcast. This is like the podcast should be your catalyst to get information, and then look for that information and get further information so you can make an educated guess. Because a lot of this is really being informed as much as possible in order to make a good investment.
100%. Yeah, and being informed doesn't guarantee that you're going to make good investments, but it will guarantee
Yeah,
that you make better investments than you otherwise would. And that's
no,
that's
absolutely. No, no, thank you very much, Darius, for having me on.
Kris, man. I appreciate you, man. So Kris Naidu, founder and CEO of Zeacon, private investor extraordinaire. Appreciate you for your time, and we'll catch you guys back here next month. Cheers.